Now, when it comes to corporate stock, there's a few terms that we need to be aware of. First is authorized stock. So authorized stock is the number of shares that a corporation is allowed to sell. Now, they don't have to sell all of these shares, but it's how many they are allowed to share. So shares that they're allowed to sell is called authorized, and ones that they've actually sold, shares that are held by stockholders, are called issued and outstanding. So the number of authorized shares is always going to be higher, than the issued and outstanding shares. And it most likely, and most of the time, is going to be very much higher. There's going to be a lot more that a company can sell than that they actually do. And this is typically because if they ever want to sell more, then it's kind of a pain to go and authorize more shares. So instead of going through that process every single time that a company wants to raise funding by selling shares, they just establish right off the beginning, hey, we're going to authorize 2 billion shares that we're going to sell, but we're only going to sell 1,000 of them. And then if in the future they want to sell more, or now they can, they've already been authorized to sell. So an authorized share is how many shares the company is allowed to sell. Issued and outstanding is going to be the stock that is held by the stockholders that have actually been sold. Now, selling or issuing stock, that's going to be sold, or like the process of selling the stocks. Now, this could be done either directly or indirectly. Directly from the company to an individual. This is typically in like a privately held corporation that they will sell their shares directly to the person buying it. They have that connection. They've met with the person. They know who they're selling it to. Or it could be indirectly, which is typically done through like the stock market, where it's somebody, there's an agent in the middle who is facilitating the sale of those shares. And now the market value of shares is going to be what these shares are selling for. And that's just really the stock price. That fluctuates every single day. If you look at the stock market, what you can buy a share for in the morning is going to be different than what you can sell it or buy or sell it for in the afternoon. So it's always fluctuating, that market value of a share. Now, the par value of a stock is going to be the minimum legal capital that is required to buy into the company. So most stocks will have a par value. So this is typically very, very low, and it doesn't mean anything when it comes to the market value at all. So these are typically some are $5 and they go down to a penny. It's a $1 par value, but it's worth $200. And so really it's just the minimum legal amount the legal minimum amount of capital required to contribute in order to buy that stock. So the selling price can go above the par value of a share, but it cannot fall below the par value of a share. So that's a par value stock. And then there's a no par value stock. These are stocks that don't have a legal minimum requirement. So it's just whatever it's worth is what you can buy that share for. And then the stated value stock is very similar to a par value. It's a no par stock that has an assigned stated value. So and it works exactly the same. Stated value per share is the minimum legal capital required to purchase a share. So, and again, a par value, the par value listed, the no par, the stated value has no effect on the stock's market value. And so there's also different types of classes of stock. So common stock is going to be really the most common. It's the most generic stock that somebody can buy. But there's what's also called preferred stock. So common stock usually allows the owner of that stock to vote, to collect dividends, to really just be an owner of the company. Whereas as a preferred stock will typically not include the right to vote, but is preferred because they will get the first of the dividends. So sometimes if a dividend is declared, the par or the preferred stock gets paid first, and then the common stock gets paid. So, and that's why it's preferred. They are preferring the dividends, and they're being prioritized when it comes to being paid out the dividends. But in exchange for that, they're not allowed to vote. And so typically, the preferred dividends and the common stock or the preferred stock, the common stock, are going to be sold at different prices because there's different rights, there's different values associated with those rights. So there are a few different classes of stocks, and even our text gives us the example that Amazon has authorized, so they are allowed to sell two types of stock, common and preferred. But they have only ever sold and issued common stock. So they have established from the beginning that we have the right to sell preferred stock. They just never have. So those are authorized, but those are not issued. Those are not outstanding. So those are just some key terms that we need to be familiar with here. Lastly, stockholders' equity consists of two parts. One is retained earnings, which we're familiar with, and two is going to be paid in capital. So this will have a few different names: paid in capital in excess of par, additional paid in capital, or APIC, APIC, additional paid in capital. Those all mean the same thing. So paid in capital is going to be the total amount of cash and other assets the corporation receives from its stockholders or shareholders in exchange for its stock. And so then retained earnings, which we're familiar with, is the cumulative net income or loss not distributed as dividends to its stockholders. So that there makes up our stockholders' equity. It's going to be our retained earnings plus what we receive for the issuance of our stock.